Hi there. We're now meeting with Martin-Kamenski, he has his own accounting firm, which is Rockstar CPA. And he's also my accountant. And he works with a lot of artistic people in the, I don't know where, in the arts, and a lot of creatives. And he understands this stuff pretty well, I think really well. Otherwise, I wouldn't be working with him. I think he's fair, I think he's honest, I think he's direct, and I think he knows his material. Martin, that said, what do you want to talk about? Oh, I see the problem. I have to unmute Martin. Okay, Martin, take it. You got it.
You muted me, Paul.
Sorry, dude.
That's not a fair way to start. I think a good place for us to start is to talk about what makes each of you people that are sitting in this room a business. It's not as exciting to talk about as curating shows, but it's a necessary evil nonetheless. And if you do it right, it can be, I think, a valuable part of what you do. I think you can, I think the strength of what you're doing financially can help support your artistic endeavors as well. To begin, let's start off first just talking about what is the difference between art as a hobby and art as a business. There may be, each of you may have your own idea of what that means personally, but there are a few guidelines as how that's determined by the government and anybody else that's going to be enforcing laws against you. One of the big things, basically the only definitive test between the two is whether or not you're consecutively losing money year after year after year. The IRS will let you lose money, meaning spend more on materials and travel and research and such than you're taking in over the course of a year. They'll let you do that even up to 5 years in a row. But once you cross that 5-year mark, 5 years in a row of losses, they generally say to themselves and to you, no rational human would believe that you could lose money 5 years in a row and then still keep trying to have a profitable business. And at that point, they would determine that you are now a hobby. Why do you care? Why do you want to be one or another? Well, if any of you have had experience in showing your income and expenses on your taxes, you might have discovered that losing money in your art making is not necessarily a bad thing when it comes to taxes. It would be ideal for you guys to be making a lot of money and have the opposite problem. But if it is the case that you are investing in your careers or getting started, for whatever reason, you are running in the red, so to speak, what that does in effect is offsets money you make elsewhere in the world. So let's say you have a side job where you make money doing some other things. Your losses from art making offset against that other income and let you make that other income tax-free in a sense. That only happens if you are treated as a business. To the extent that you are viewed as a hobby, they still want you to show your income and they still want you to show your expenses. But the main difference is you're never going to they will never allow your expenses to exceed your income, meaning you'll never end up with a negative number. You won't be able to take advantage of any of those kind of losses. That's kind of one general overview about businesses and hobbies. On the less clear-cut side, there are some qualitative characteristics that go into looking at you and determining whether or not you're taking yourself seriously as a business. Some of those things might include, did you bother to set up a separate bank account maybe to track all of your business income and expenses? It's not a bad idea no matter how you structure yourself business-wise, just because, let's say they have a question about something and want to look into your business. By isolating all the activity in one bank account, what you're limiting them on is their scope of investigation. So now they're only going to be able to look in one bank account. They're not going to look through months and months of statements of personal income and expenses, which you may not want them to see. I don't know. I wouldn't want them to have to see anything more than they need to. So that would be one delineation. do you advertise? Do you go out and try to make money? Do you seek new clients? Are you trying to get your work in galleries? Are you promoting yourself online or in print? Those kind of characteristics help as well. And then also just the overall strength of your record keeping. And I'll talk a little bit about that later. But in general, you can think of it as showing that you take yourself seriously is going to go a long way in determining that you are in fact a business, which is kind of favorable as far as we're concerned. In general, I'm going to talk right now about three different main components that, three different facets of your business that I think would be helpful for you to get a little more information and background on. I'll give you some of my personal suggestions about what I think the best methods or tools would be to employ in these areas. And then just touch on a couple things really quick, and then I want to open it up to questions, because usually when I speak or do presentations, the question and answer part of it is where we really get hopping. So I'm going to try to blow through this as quickly as possible. Paul, if you could do me a favor and keep an eye on comments, and I'll pause here and there to see if anybody's got any questions.
Perfect. Okay, you got it.
All right. So first things first, you may be curious about what you need to track and how to track it. I kind of break down that world into two different areas. You have the digital component to that, or hopefully most of you will be going in a digital way. And then you have the physical, real world component to it. Let's look at the digital side of it first. What you need to track and how. I strongly, strongly recommend for anybody that's in the practice of developing an art career that you use some kind of computerized technology to track your income and expenses. I honestly don't care what it would be. There are a number of tools out there, and the most
something like QuickBooks, right?
That's right. That would be one of them. The most important quality for that tool, for that software to have for you is that you like it. That you like it a lot and that you're actually going to use it, because you could get the perfect system that's the exact right fit for the kind of business you are, but if it scares you or if you aren't used to it or uncomfortable, it's ultimately going to be worthless. At the end of the year, you're going to be trying to plug everything in all at once, like you're in college and pulling it all later. So instead, even if it's a spreadsheet, a simple spreadsheet that shows your income, every time you get a check, you record it as income, your expenses in another column that are categorized, so you label what kind of expense it is. Any means necessary is fine. There are
pretty much, if you've got a separate checking account for your business stuff of your career, you know, like buying supplies and depositing checks from sales, and you're doing it on a computer, and you're balancing your checkbook on a computer, it's happening by default, isn't it? Everything's just falling into place if you bother to stick the right labels on it.
That's right. That's the benefit of a lot of those systems as opposed to a spreadsheet, is that by forcing you to balance every month, it's also forcing you to include everything that happened and to not include any garbage that you accidentally entered. So it makes you hold true to the reality of what happened, which is always what the bank says happened.
Cool.
There are a couple new tools. One of them that I'll point out, and that I really wish I was earning ad dollars for plugging, because I've been plugging it quite a bit lately. But this is a tool called Outright. And what they're trying to do, for those of you that are familiar with mint.com, Outright.com, O-U-T-R-I-G-H-T, is essentially like a mint.com for businesses. So the categories are set up along the lines of what businesses spend money on. The focus is not so much on personal finance and spending, but on business spending. And it also has a built-in calculator that is monitoring what your income and expenses are like and how much you might anticipate owing in taxes as a result of your income and expenses. It's keeping a running tab on this all year. Every time you log in, you see exactly where you're at. And what's maybe most exciting about it is like Mint.com, it attempts to categorize everything for you as these transactions happen. So it's seeing that you went to Shell and it's labeling it as auto expenses or gas. It's easy to buy airfare and American, it puts it down as travel. So it cuts out a lot of that work for you, and all you have to do is double check that it actually got the categories right. So, like I said, whether it's a spreadsheet or a system like Outright, or if you have a more established business, you've incorporated and you're dealing with things like payroll taxes or shareholder loans and distributions, those are the slightly more complicated aspects of accounting that these simplified tools aren't really built to handle. And in that case, you might be looking at a system like QuickBooks instead, something to that effect. That's kind of the digital world. And like Paul said, as long as you're using a system that holds you to task, at the end of the year, turning over your information to a tax preparer or sitting down to work it through yourself is very easy because all of the work has been done little by little in increments along the way, which for anybody that has tried to assemble everything for a year in the couple days before you meet with your tax person, could tell you it's probably an advisable course. That's the computer side of it. Then what do you do about the physical side of income and expenses, the paper? What do you do with all that paper? Because you may be buying and selling things online and whatnot, but you're still going to end up with receipts from the supply store, with receipts from travel, and what do we do with those things? I want to throw a couple things for you. Take what you like and ignore what you don't. One good place most likely for any of you to start, given the nature of what you're doing and the volume of transactions, is to go to the office store and just get a 12-month accordion file. Something like that, which you're also going to write off as a business expense, lets you just dump anything that happens in a month, whether it's income, expense, or receipt from one thing or another. It doesn't really matter. Throw everything into one month. When the month closes, move on to the next slot, and on and on. The reason it doesn't matter how you put things in there is because you've already taken care of that on the computer side of it. You've tracked it. It's tagged already with what kind of expense it is. All you're doing with the paper side is reducing your search time by 1/12 or to 1/12. So you at least know if I got to find something, I can go back to exactly what month it was in. The odds that anyone's ever going to ask you to see this stuff is slim enough that I think that's a pretty safe amount of effort for the likelihood you're ever going to be asked to see anything. There are some alternatives to that as well. You can scan receipts and paperwork if you're trying to go paperless. That's perfectly allowed. It has been for decades. They decided that a scanned image of a receipt is just as good as the real thing, so you can have those. If you have things saved electronically, as with anything, just make sure you've backed it up once or twice, as you'd hate to see that data go. And then there's one more tool I can throw out, which might be of help for some of you, and it's a tool that we actually developed internally. If you are on our website, rockstarcpa.com, you can find it there. It's called a tax tracker, and it's an app for phones, for any Android-powered or iPhone. And essentially what it does, in short, is it lets you snap pictures of receipts as you go throughout the year, any kind of the paper kind of receipts. And it scans them, zaps it up to the cloud. It gets read, all the information pulled off, the names, dates, amounts, and all that information is zapped back into your phone, and you can toss the paper. All the images are saved on our servers, and you have access to that at any time. So that tool has been pretty successful for clients of ours that have bought in and are using it. And we continue to do that, to add aspects to that all the time. We just made a major update to the mileage tracking in it as well, which lets you use the GPS in your phone to essentially, you get in the car if you're traveling for work, if you're on your way to a show or to a gallery or to meet with a colleague. You just get in the car, press the button, and it uses the GPS to track how far you've traveled. You press stop, and it records the mileage for you. So you don't have to make it up at the end of the year like most people do. Then we get to, well, I guess that's it. So that's most of what I had to say about tracking income and expenses, where you should be tracking it, the kinds of things that we are looking for. I'm going to go into some specifics about deductions at the very end because that's usually the area that has the most questions. But if anybody has a not is this deductible or not question at this point about what I've said so far, maybe we could look at some of those.
There are some questions. I don't know. Maybe Ken, is joining us from Yellowstone, has a mediocre connection. Let me see if Ken has a good. I can ask his question if he's not, if his connection isn't quick enough for him to. Hey Ken, I've unmuted you. No, I haven't. I have unmuted you now. Oh, then you remuted yourself. Oh, there we go. Ken, try and ask.
Can you hear me?
Yes.
Okay, but I don't know if my question relates. You just want a question on deductions at this point?
No, not deductions. So I think your question relates because we're holding the questions on deductions. And it looks to me like your connection's getting fuzzy. Try it, and if you can't, I'll ask.
Okay. I'm not sure about registering myself as a business, and if I do my previous expenses from the year prior to registering count, even though they're all over the place?
Okay, I got the question, I believe, and I'll repeat it to make sure I've got it and for anybody else. I believe the question was, let's say you determine mid-year that you are going to register and start treating yourself as a business. What about the expenses that occurred, the income and expenses that occurred before that? The answer is that you look at things holistically for a year. So regardless of exactly what point in time you elected to register or you decide for yourself that you're going to treat yourself as a business, the income and expenses that you've incurred all year long, you can process the same way. You don't have to.
What about the previous year?
The previous year, that gets very tricky. In general, as far as most income and expenses go, no. That will be limited to that previous year, and once you've moved past, you're done with those expenses. There's one major exception, and that's with major assets that you purchase. So these are things that you've bought and, let's say, continue to add value to what you're doing year after year after year. In those kind of cases, then yes, then what we let you
like an etching press.
Yeah, you depreciate and you write off a part of that cost for the current year and any other year that you're using the asset.
All right, now you used the term, Ken, I think that answered your question. I'm going to segue to something different. You used the term register. What does one have to do to register to be a business?
That's a good question, and I was going to come back to that.
Okay, fine, we can wait. Why don't we stick with your program?
Yeah, we're going to talk about different kinds of structures next, different kinds of ways that you might want to organize yourself. And depending on the structure you choose, there may be absolutely nothing involved. Your process may be as simple as hanging a sign on your door and saying, I'm in business. Some of that varies locally. So there may be different restrictions area to area. For example, in the city of Chicago, you're required to get a city business license. Even if you're one person operating a business out of your home, such as an art school that carries on web conversations.
Me. Yep, there you go.
Yeah, so now as a matter of course, does everybody do this right away and on time like they're supposed to? Not necessarily. It doesn't matter. But that's actually a good segue. Let's talk about a few of the different structures. Oh, look at that. Paul
Wait a minute.
He has his license.
There you go. Yeah. Is it current?
Well,
this one was printed in 2008. This one's expired, but I got more.
You can run those right off your printer yourself, Paul. I'm sure.
I got a lot of them. I got 3 of them here. I'm gonna see if one of them's current. Anyway, I'm sorry to interrupt.
Yeah. Let's see. As far as structures go, the one thing to consider, the main driver of what's going to push you in one category to another is your level of income and expenses. I want to define something really quick so that I can use this term and know that everybody understands what I'm talking about. For the next little while, I'm going to be referring to net income. And by that, very simply, I mean your income less all of your expenses. So you took in $20,000 in sales for the year, and you spent 10. That means your net income is $10,000. That's what you cleared after your expenses. Depending on where your net income falls for the year, there are a number of different business structures that might be useful to you. Most people, when they get started, operate as sole proprietors. And I was talking to Paul earlier before this presentation, and he was of the understanding that most likely many of you are already carrying on as sole proprietors. If you are doing that, what does this look like? You may be receiving 1099s for the work that you do. You may also call yourself an independent contractor or self-employed. You would typically file your income and expenses on a Schedule C of your own individual tax return. These are all things that characterize somebody that's operating as a sole proprietor. And for a sole proprietorship to begin, the cost, I'm going to go through a few different aspects of each form of business. The cost for a sole proprietorship is 0, and that certainly makes it attractive as you are getting started. It's helpful in that way. It also takes no filing. You can, like I said, just hang a sign on your door and say, I'm in business, and carry on as a sole proprietor. At that point, your only responsibilities are to keep track of your income and expenses as we had discussed. So that form of business works very well for people that are running a loss for the year. So anybody that's in the negative realm, all the way up to, let's say you're earning about $25,000, $30,000 net income. So that's after your expenses, you're about $25,000 or so. Then we start looking at another form of business, which would be incorporating. And without getting too heavy into the numbers, there's a tax strategy that can be employed by incorporating, whereby, in this case, what I do for most individual artists that are their own business is set up an S Corp for them. And the reason is, for anybody that has operated as a sole proprietor and has made a profit, you may have also been bitten at the end of the year by the self-employment tax bug, which can come out at you without any warning and drop an extra 16% tax on your tax return. Especially if you had a really good year, this is really bad news. So what we're able to do by setting up an S Corp where you are both the owner of your activity and the employee is we get to determine how much you pay yourself in wages. thereby determining how much you have in payroll taxes, as opposed to when you're a sole proprietor. Essentially, they say everything that you earn is your wage, so you pay payroll taxes on all of that. That strategy can end up saving you thousands of dollars if you are clearing about $25K. That $1,000 savings starts to cover the cost of being incorporated. So essentially, you pay for your incorporation in full by tax savings at around $25,000 a year. The more you make after that, the more money you're saving every year, and the cost essentially stays the same. So that's one of the benefits of setting up as an S corp. Now, what will this cost you? Depending on where you go and who you have help you, it could cost anywhere from $200 to $500–600 to set up. And in general, as a rough estimation of how much it costs you ongoing throughout the year, it's about $1,400–1,500, something like that, including your payroll taxes and your year-end corporate tax returns and all of that. But like I said, you'll end up saving about that much money in taxes anyway, so at that point it pays for itself. What would be another consideration for why you might want to incorporate? There are two other reasons why people look at it as an option. One of them is liability. This is a big difference between operating as a sole proprietor on your own and carrying on a business as an incorporated entity. When you're on business as a sole proprietor, not only the things in your business checking account, the money in your checking account, the business tools and supplies and inventory that you have, all of that is on the line, so to speak, for your business. But in addition to that, if anything were to happen and someone were to sue you, they could go after anything you have personally, your house, your car, any personal effects. The art world is, I don't know, Paul may have some better insights into this. In my limited experience in the visual art world, it's not a heavily litigious profession until you get kind of up in the higher ranks.
True.
Is that right, Paul?
Yes.
Yeah. So I wouldn't put the risk factor too high in terms of looking at liability as a reason to incorporate. But if it's something that you're very concerned about, you do get that little extra protection. And the third and final decision factor involved in whether or not you incorporate would be, this is probably the least important for most people, but it's image or prestige. There's something that looks or feels a little more established, reputable, et cetera, if you have a corporate name. That may be a little less so in the visual art world than in other artistic professions.
Couldn't you just get an American Express card and wear it on your brow?
That's right. Yeah, if you can get them to give you one of those black cards, then yeah, I would stick that out your shirt pocket and give me a call and take me out to lunch. But yeah, those three factors, if you are leaning one way or another, hopefully looking at those three decisions might give you an idea of whether or not it's time for you to incorporate. For most of my clients, the most important thing for me is where they are financially. If you are clearing enough money year after year that it pays, I think it's a very good idea. Short of that, I think it's a bad idea to get into it too early if you're not making enough money yet, because there's really no sense in spending all that money on corporate tax returns and all the other work you need done if it's not going to garner you any benefits. So that's the S corp structure. For any of you that
hold on, Martin.
Yeah.
Katina had a question. Katina, go ahead and unmute yourself and ask.
Okay, let's say that I incorporate myself because I have adequate earnings to justify that. The first question is, what happens to the money that doesn't come to salary? Are there restrictions on what I might do to that?
Okay. The answer is no. Generally what happens is we take, for most of my clients, we give them 50% of what they were profiting and pay that to them as a wage. So essentially what we've done is cut their self-employment tax in half. Now, there's another 50% of that profit that's ostensibly just sitting there in the bank account. What can you do with that? It's allowed to pay yourself the rest of that 50% as a dividend. Now, if you do that, there are many words for that. You could call it a dividend or owner distribution or shareholder distribution. These are all the same thing. But what that is essentially is a second form of compensation for you where you are paying yourself as the owner of this activity. And that income is paid for already through the business. You don't have any separate taxes associated with it. So you can take it or not. If you want to leave it in the business to have the funds there to help grow or to spur on the next project, you can leave it in there. Or if you are comfortable and want to take it out, you can pay it to yourself in that way and not have the same tax implications.
Okay, so that gets taxed as capital gains or something?
No, it's not capital gains. It's taxed at just your normal marginal income tax rate.
Okay, and then, God, this can't possibly work with joint filing.
Oh yeah, absolutely. So you would include the wages that you paid yourself on a W-2, just like you would get from any outside employer, and then the rest of it gets transferred in on a K-1, which is like a W-2. It's a transference of money onto your individual return, and you pay for the profit of the business, whatever's left, just your normal income tax rate on that on your joint return. It just drops that number on page 1 of your return.
Okay, that sounds great. Thank you. It's very helpful.
So,
wait, one more.
Yeah.
Go ahead.
Let's say I don't know whether I want to incorporate until the end of the year. Can I do it after the fact, like the same way I can add to my IRA? Can I do it any time before October? Or do I have to do it now for it to be valid?
Yeah, in general, you want to be doing it in the year that you want to start. And I would go so far as to say you would probably want to do it even within the first half of the year. I've done some, I guess, shotgun incorporations.
You're still stuck on the married analogies, aren't you? I got it. There it came. It came. Okay.
Yeah,
and you guys are pregnant, huh? I didn't know that. Thanks. I've tried to get them in under the wire, and really what ends up happening more than anything, just by virtue of how you're paying for everything in this case, you end up having to write a huge check for all the payroll tax part of it, all in one chunk at the end of the year. By setting up that business and letting it run for at least half a year, you're able to spread out those payments over a slightly longer period of time. So it definitely has to happen within the year. I would advise you to do it within the first 6 or 8 months. And certainly Well, let's say Katina's convinced that she should do this, and here it is the middle of August. Should she wait till next year?
It's a gray area. I would say it depends on how much she is looking, how much it looks like she will need to pay in payroll taxes, what the cash flow is like for her. Can she withstand that in the next 4 months, paying all that in? Because your payroll taxes essentially have to be paid in by the end of the year. So can you swing that? If you can swing it, then sure, then we'll try.
And payroll taxes are my Social Security, investment, and whatever.
That's right.
Is that right? Okay. So what would ordinarily be withheld?
I'm sorry?
What would ordinarily be withheld? Is that right?
That's right. It's what's withheld, and for those of you that are operating sole proprietorships now, it's what gets added on that return as self-employment tax. That is, in a sense, payroll taxes.
That's under 10% though, isn't it? Isn't it like 7, 8%?
Well, what gets withheld from a paycheck is 1/2 of Social Security and Medicare.
Oh, right, because the employer's picking up the other half. So you're talking 15% or something then, right?
That's right. It ends up being about 15, 16%.
Okay. Hey, Ken had a question, and I'm not sure I understand it entirely, and I'm going to interrupt him now for this question. He said if I have a campaign to sell 100 paintings for $1,000 each to pay off my student loans, is this complicated crossing the money over from my corporation? Oh, I get it. Okay. Can it,
Yeah.
So he incorporates, can his corporation pay off his student loans?
The answer to that, in short, is no.
So he has to take the money as income and then pay off the taxes and then take what remains and use it to pay off his student loans.
That's exactly right. So it would be 50% of it would come through in the form of wages, and you'd have to be paying payroll tax on that. The other half of it, you could skip the payroll tax on, but at the end of the day, yes, you would be paying tax on all that income, and then you, as the person, can go and pay off your student loan.
Okay.
Yeah. The last structure that I want to talk about as an option is for when you cross even further into making lots of money. You're clearing $25,000, $30,000 a year. You are selling lots. You're wildly successful, and now you're clearing $275,000 a year. At that point, again, the first step is to give me a call and take me out to lunch. And at that time, I will discuss with you how we make you a C Corp. The reason being, in short, is a C corporation. That's the kind of corporation that Boeing and General Electric and all those people are. Were you to be making that much money and still be an S Corp, the burden on you personally to pay the income tax for all that money would be too great. So you let the business essentially pay for itself, which is the main difference between S and C. I'll talk about this right now. I was going to do it later, but I'm going to talk about LLCs right now for a little bit. I'll give you my 2 cents on LLCs after I take a sip of coffee. So LLCs are a very popular form of business, a legal structure. And the reason was, back in the day, that they allowed a good bit of flexibility. Essentially, when you set up with the state that you're an LLC, the IRS lets you check a box. And at the end of the year, you say, I want to be treated as a sole proprietor, or I want to be treated as a partnership, or I want to be treated as a corporation. And you just get to pick at the end of the year. You just check a box and that's it. That flexibility was unheard of at that point, and a lot of people went crazy about it. The states, since then, have realized how attractive it is and have, in many cases, jacked up the fees for how much it costs to set up an LLC versus any other form of business. In the state of Illinois, for example, setting up a corporation or an S corporation or anything costs you $125 to the state and then $100 a year thereafter. An LLC costs $500 to set up and $500 a year thereafter. So the significant and in many cases, I would argue, unnecessary additional cost. The reason is it doesn't do anything other than let you be one of those other things you can already be anyway. So if you want to be a sole proprietor, just be one. The liability protection is the only part of incorporating that you get out of the LLC. You don't get the tax benefit. And yes? So you don't get that benefit, and instead, you just end up paying a lot more in fees. On the incorporating side, you can just go out and set up that corporation and not just do it directly. Don't make the LLC and make that election. Just instead set up the entity itself for less money. In general, most of my clients that have come to me as LLCs, we've had to kind of do a switcheroo and get them set up in a different way, which is a web of paperwork you probably don't ever want to find yourselves in. I will give you one exception, one major exception to my avoid LLCs rule, which is they are still the most efficient way to set up a partnership. So you don't have to have an LLC to set up a partnership. You can set that up just by yourselves. Two people that want to go into business together, like almost a merged sole proprietorship. Two partners can go out and just start doing business together as determined. But if you want to make it a little cleaner, if you want to have one record where this is what happened in the partnership, this is my share, and this is your share, that can really only be accomplished by using an LLC, which has its own set of books, and then it splits everything out to both people. So if that's what you're looking to do, if you're looking to set up an operation whereby you share the work burden or the financing burden, and certainly that you're sharing the income and expenses and tax responsibility for this business, whether it be an art collective or a gallery or any such cooperative kind of work, then a partnership might make sense and an LLC might be the way to go for you. But as an individual practicing artist, in general, it's not the best option. While we're at it, also, I'll throw out a little word about some of the safe haven states or otherwise attractive states to set up in, like Delaware. A lot of people think you should set up a business there, or Florida. Nevada, they have no state income tax. That's got to be great, right? And the short answer to that issue is that, by and large, the benefits that could exist from being in those places don't really pay for smaller organizations or smaller businesses. And the reason is, if you set up a business in a state that has no income tax, as long as the money stays in that state, that's fine. But as soon as you start trying to repatriate it to where you live and where you need to spend that money, you're going to be paying income tax on it here. So there's no sense in setting something up way over there and paying somebody else to be your mailbox or your address in that state because you don't really live there, when you could just set up the business locally and skip that cost. 9 times out of 10, the ideal place to set up your business is exactly in the state that you live or the state that you're going to be doing the most work in, which, if you're nearby on borders or such, might be a little different, but mainly it's where you live. So we talked a bit about what to keep track of, how your systems are going to be set up to keep track of things. And we talked about a few different structures. I want to talk about one more aspect, and then we'll talk about some deductions and take questions. The last thing that you need to be thinking about as you carry on is keeping an eye on the taxes that you might owe. So long as you are spending just as much or more than what you make, you really don't have to worry about the tax burden that you're creating for yourself. If, however, you do sell and you are making more than what you spend, depending on how you set up legally, you're in one way or another going to be creating some tax burden for yourself. So how do you deal with that? What are some good rules of thumb? Well, if in general you think you fall into this category where you will owe taxes based on your artwork, you will probably want to go either a gross sales approach to it or a net sales approach to it, depending on how you keep track of things. Some people will set aside maybe 10% of every dollar they sell. The reason that even if you have maybe a 15% tax rate, that you can set aside 10% of what you sell, well, because you have some expenses. So you're not going to really be paying on the whole dollar figure that you sold. It's going to be knocked down some by your expenses, but maybe 10% works. On the other hand, maybe you track very carefully and you're very aware of your expenses also. You can get more precise about how much to set aside for taxes by looking at your net number, because that's ultimately what you'll be paying taxes on. So maybe you set aside 15% of your net, or 10%, 10, 12% of your net income after your expenses. Because you know what they are and you're keeping track of it along the way. Or you use a tool like Outright or another system like that that kind of monitors and plugs that along for you. For those of you that have ongoing recurring tax liabilities, you may be requested to make quarterly payments of these taxes, whether it be in the form of payroll taxes or as an individual in the form of quarterly individual estimated payments. Some of you may have heard of people saying that they file taxes quarterly. Well, nobody really files a tax return every quarter, but some people send in estimates of what they're going to owe at the end of the year every 3 months, just to keep current, to get that money out of your hands and into the hands of the government, where they will also carefully be custodians of that money and spend it only in the manners that you see fit, depending on who you believe. So that's the last final component to maintaining and keeping a decent business structure around yourself. It's keeping track of things, knowing how to keep track of it all. It's about choosing a structure that's good for you, that is not more complicated than you need, but that supports where you are at financially. And third, to look at your taxes as you go throughout the year, to try to get a sense of how much you might owe, so that you can, if needed, contribute it along the way, or at least know as you're getting through August, September, October, what am I going to be looking at when I sit down in February or March to file some tax returns? Am I going to have to write a big check, or am I going to get something back? It's always my goal with clients to try to have as few surprises as possible by the end of the year. So those are the three things. The last thing, I'll just talk real briefly about a few different areas of deductions that I think people have some general questions or misconceptions about. I'll start off with this. This is maybe, hopefully, is one of the most valuable pieces of information I can pass on tonight, and it's my golden rule for whether or not you can deduct something. This is kind of going, rather than give you guys a laundry list of things that you can write off, this is kind of the teach a person to fish method. And my golden rule for whether or not you can write something off is this: if you can ask yourself, do I have to spend this money in order to make the money that I made? Anything that answers true to that statement is going to be deductible, and I frankly don't care what it is. I have clients in a lot of various and very unusual professions. The kinds of things that are business expenses for a ballet dancer may be very different than those of a professional wrestler or those of a boxer. You know, there's no rule about what you can and can't spend money on for your business. The most important thing is that you are able to be honest with yourself and say that, yes, I did have to spend this money in order to make the money that I made. Does that mean on every single thing? Do you have to, let's say you went out and bought 100 soup cans because it was part of an installation you did, and let's say that never sold. That doesn't matter. The idea is that these are components that are going into what you sell. And as such, even if you sold a piece or not, these are costs of you trying to get out and do business and make a career for yourself and earn a living. So anything that falls in that category is going to work. Now, 3 really big categories just to knock down some walls for you. Travel. As far as travel goes, you're allowed to deduct airfare, ground transportation, hotels, anything. One thing that I'll advise you to keep track of separately is your meals while you're traveling. As far as the IRS is concerned, you are traveling if you are away from your home city overnight. So there's no one-day, in-day travel. That kind of doesn't fly. But if you've spent the night away from home, you can deduct any of those travel costs I mentioned, and the meals that you incur along the way are 100% deductible, which is different than meals that you have in your home city or while you're meeting with colleagues or out with friends. Those kind of meals are usually only 50% deductible. So track your travel meals separate so you get the full benefit of that. Also, what's happening increasingly is kind of the business and pleasure mixed travel kind of thing. And while that's perfectly okay, what you want to do is arm yourself at the beginning, from the forefront, with an estimation and then something to back up how much of your trip was business and how much was personal. If you can break it into days, that's great. If you can show a calendar where you show these appointments and I was meeting with these people and going here and there, and then Saturday I just blew off and hung out with some friends. Ultimately, what's going to happen is you're going to take the total cost of that trip, bundle it together, and write off the percentage, the fraction of it that was work-related. So on a 4-day trip, you spend 3 days working and hung out one day, you're going to write off 75% of all those expenses. Research is another area that you can write off some spending. And I think it's a widely underutilized category, maybe the most underutilized expense category for an artist. If you think of what goes into an artist's profession, what feeds you and helps make you better at doing what it is you do, the sky's the limit ultimately for what you could include as a business expense that's research, that's helping fuel your work. So I advise clients to be as aggressive as you can with research expenses, as long as you take the step of backing yourself up. Draw the line, make the connection for yourself so that you might be able to explain to somebody if they ever ask you, well, why did you write off the membership to that museum? Or why did you write off this book that you found in the bookstore that made you think of this thing and then that led to that project? If you can connect the dots for yourself, you'll be able to explain it to somebody else, and that person can take away the same understanding. You'll never have a problem writing off the bad deduction. It's when you just start writing off things at random and not really processing it that you run into trouble. But research can be a huge area that artists and creative professionals can write off some things that to most people it's not a deduction. But for you guys, it can be a valid business expense. The last thing I want to hit real quick is home offices. So the rules changed about home offices not too long ago. It used to be the case that a home office had to have 4 walls and a door. So it needed to be a closed-off, confined space. That's no longer the case. For those of you that have loft spaces, you'll be glad to know that wide open spaces that just have a defined work area are totally fine as well. So in normal or more traditional home office where there's walls and a door, you're still going to take a percentage of all of your costs of your home. If you own the place, your mortgage, interest, and property tax. If you rent, it's your rent. In either way, your utilities, landline phones, internet access, heat, gas, et cetera, you write off a percentage of all of those things based on how much of your home is used for work and how much of it is used for other purposes. What if, as some of you may be involved in or in the practice of, what if you have a separate studio space? A lot of people ask me, I'm thinking of renting some space. Can I still get a home office? The answer is yes, you can. As long as you are still meeting the 2 criteria that are left for having a home office deduction. You need a space that is, number 1, regularly, and number 2, exclusively used for work. So the dining room table that also serves as your email station for when you're marketing yourselves, that's not really going to cut it. The closet where 2 times a year you store your overrun supplies because you're building up for a show. 2 times a year is not really regularly, as far as I'm concerned. Exclusively is pretty cut and dry. How often does regularly mean? I would say monthly would be enough. But if you have some area, some space in your home that is regularly and exclusively used for work, you write off that portion of your expenses, even if you have a separate space that you rent. Okay, so that kind of wraps up what I had planned to talk about, the core aspects of it all. At this point, let's start first with any questions about things that I've talked about so far, and then if you guys have questions about things that are, what about, can I write this off or that off, we'll take those as well now.
Assuming that there's a bunch of questions, why don't you guys raise your hands? And Lynn asked a question, which I'll just ask for. If you're converting, or if you, from paper records to digital records, how long do you have to hold on to that paper?
Well, if you've scanned it digitally, you don't have to hold on to the paper as long as you're comfortable that the...
yeah, but let's say you don't want to bother scanning it, and you've got this... Huh?
Right. If you just save the paper and then you move to a digital system, you want to keep those records 7 years.
Wow.
There's a 3-year statute of limitations, but if they feel like it, they can basically extend it. So we say generally 7 years to hang on to that paper. Put it in a box with a date on the outside that says, shred me on blah, 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 +7, and then destroy it when you get the chance. But that's the short answer.
Okay, cool. Katina, go ahead and ask your question.
Okay, so how does the home office work if I own my own home? I understand the whole gas and electricity part, but what part of, say, mortgage insurance tax would?
So it's the same percentage. It's still based on the relative amount of space. And in your case, right, instead of rent, you'd be writing off a portion of mortgage interest and property tax. Why does this matter when you get to write off mortgage interest and property tax anyway on Schedule A? Well, the difference is, let's say you're writing off 20% of it. You can shift 20% of that deduction from Schedule A to your business. Let's say that's on Schedule C if you're self-employed. There, it's helping you reduce those payroll taxes that you're trying to pay, that you don't want to pay, right? So then on Schedule A, you get a benefit, but on Schedule C with your business, it gives you that benefit and more because it's also reducing your payroll taxes. This is that self-employment tax. You're still going to end up with all the rest of your mortgage interest and property tax back on the original spot where you normally write it off.
Okay, and what if the number's insane, like more than 50%?
Yeah, I would say 50% is certainly above average. I would say most home offices fall in the 12 to 25% area, though photographers, visual artists certainly have more because they have, you know, either space that you have, you're testing out display, so you're looking at how things look on a wall, and so you have a lot of wall space you're using, or you are just stockpiling work. In those
No,
cases,
my studios are in the house, so I have literally hundreds of square foot of studio here and a back house of studio, plus all the storage, plus the office. So
yeah.
we live in a flat, and everything else is studio space.
Yeah. In that kind of situation, I would say you definitely, and this goes across the board for anything you're thinking of including in a tax return. Show the truth. Express the reality of what happens. Don't hold back because you feel. I've had clients say to me that they didn't want to include something because they felt guilty that they get to write this off because they're an artist. Don't ever cut back or hold yourself or cut yourself short. Show the reality of what happened. If 50% of your living space is related to that, that's fine. Write off 50% of it. Just be able to demonstrate that if needed, and that can be pretty simple to do with just some pictures.
Thank you.
What do you think, Paul? We have some more questions at this point, or are we dried up with questions?
Can you hear me?
Martin, I have a question if you can hear me.
Yeah.
When you were speaking of, what was it called? I bookmarked it somewhere. What was it similar to Mint.com?
Yeah, outright.
Outright. Is there a program that kind of crosses the two between Outright and QuickBooks so that you're also able to make invoices, but everything is kept online, like in the cloud, so that you're not stationed to one location? Or
yeah, I see what you mean. There's two ways you could handle that. One is QuickBooks does offer an online edition, which lets you log in from any browser, anywhere you are, and it does have built-in invoicing, and then does all the kind of full, robust things that QuickBooks can do because it's huge. Although that option carries a kind of hefty price tag. On the other end of things, with Outright, they've done a really good job partnering with a few other services, and I think, if I'm not mistaken, Outright has totally built-in synced integration with FreshBooks, which is maybe one of the most popular invoicing systems for freelancers or self-employed contract kind of people.
Thanks.
Mm-hmm.
Thank you.
I unmuted myself. I have Ken's question. I own 5 buildings to make art, research, and write in, and I will be using all of them. But what is there to write off if what is there to write off if you own something outright?
Well, so like the 2 questions ago, you have mortgage interest and property tax. In Ken's situation, I would, that is a little more complex, obviously, than just being an individual practicing artist and working out of a home or places you rent. Owning those buildings, I would wager, would probably put him in a position where you'd want to engage in a little more complex kind of structure where the buildings are in one entity or under one umbrella. Maybe you as an individual artist are under another, and maybe you pay yourself some rent. On the building side, you get to write off the mortgage interest and property tax and utilities and all that, and then even the depreciation of the building over time. That's an artist here in Chicago that has a somewhat similar situation that I'm working with, and that's kind of the structure we've gone with in his case.
Smart. All right.
However,
here we go.
Sorry.
Yeah.
However, when you depreciate a building that you own, don't you have to pay it back when you sell the building?
That depends. It depends on a number of things. If it's your personal residence, there's a certain amount of gain that you're allowed to take without incurring that extra tax. If instead you're a business, then usually yes, but again, there's an exception on the business side where if you own these buildings under a business umbrella, let's say you depreciate the value down, and then you sell it at here and you have this gain, you can roll that gain into a new property, and as long as you're rolling it forward, you'll eventually have to pay on it someday, but you can keep pushing that off into the future where hopefully your kids will have to pay for it instead.
There you go. Anybody else?
Yes.
Cool.
Mr.
Somebody want to say something?
Yes. I was wondering if I'm thinking about hiring a business manager, and was wondering if there's a tax advantageous way of doing it, especially if I want the position to become more of a full-time thing, and perhaps have some incentives like a certain percentage of sales as a reward or as partial payment or bonus.
That's a good question, and it brings up a general kind of issue, which is how do you treat the people that you pay? Do you pay them as independent contractors, in which case at the end of the year you would give them a 1099 for the amount that you paid them, or do you treat them as employees and pay them in the form of wages with taxes withheld, et cetera, et cetera? A few things. Whether you are a sole proprietor or incorporated, you can pay people either way. You can be a sole proprietor with employees, and you can be incorporated and pay contractors. It doesn't matter. The IRS has, this is an area of a lot of contention in how do you classify these people. In short, a few real quick guidelines. A person looks more like an employee if they work a set schedule, work in your location and not in their own, use your tools to carry out the work and not their own tools. If they work only for you and not that they're doing the same thing they do for you for a lot of other people. If they are given specific instructions about what to do, as opposed to a general task to accomplish. On the flip side to that, a person is more like an independent contractor if they are any of the opposite. If they are working their own schedule with their own tools, kind of just given broad tasks to finish and they can figure out how to do it, that person is more like an independent contractor. Financially speaking, for you guys, it's always going to be advantageous to pay somebody as a contractor because you don't have to pay the payroll taxes for them. They're going to have to pay it when they file their taxes. So obviously on the
that's a 7% difference ballpark.
Right, that's right. So it's going to tack on an extra 16% or so to what you, well, it would tack on 8% to what you would have to pay because you're paying half of it, right? Or it would tack 16% onto their tax bill at the end of the year. That can be a negotiation. For those of you that are looking to pay somebody, especially in Lynn's case where this is it sounds like you want to develop an ongoing relationship with this person, whatever you do, I would just try to be as upfront about it as possible. Say, hey, we could do it this way, we could do it that. I know that it's going to have some tax implications for you. I want to make sure it's a situation that both of us are comfortable with. But as far as which way would be most tax beneficial for you, paying someone as a contractor has no taxes. So that's, of course, the easiest financially.
Martin, are you cool with people asking you questions and perhaps seeking to engage you by sending you email?
Yeah, that's not a problem at all. I wouldn't imagine that too many people want to talk about taxes for much longer this evening. So if you want to write up a question and shoot me an email, I will get back to you in a timely fashion. And
I just put your email address in that chat box.
Excellent. Yeah.
You're going to get fan mail now. I find this has been really informative, and I think it was really well structured, and I think it was really clear, and I think it avoided ambiguity. I think you did a really good job. I appreciate that, and I am now unmuting everybody, so we have echo. So Martin, thanks very much. Everybody else, we have one more webinar, which is with me next week, and I'm going to repeat wait a minute. Martin, thank you, and I'm going to end this. I'm going to say a couple of general announcements. Thank you very much, Martin.
Thank you.
Thanks, guys.
Thanks, Martin.
Thank you.